All right, so we are picking it up right where we left off on the last one. Now we're going to talk about installment notes. And so installment notes are a situation where you pay a portion or you pay off accrued interest, and then you also pay down a portion of the principal with each payment. Again, these are installment loans. Car loans and mortgages are kind of the most common examples of this, and most students can kind of understand that. Usually, but not always, but usually installment loans are what's called fully amortized over the life of the loan. And what do we mean by fully amortized? What we mean is that the loan principal will start at an initial amount and then will reach zero balance with the final payment. So basically we create an amortization schedule, but in this case, instead of having a discount or a premium that we're amortizing, we're actually amortizing the loan directly, right? So it's a slightly different looking amortization table, but the math is pretty much the same. And so we'll walk through an example and hopefully that will help you out. So we acquire some vehicles for 235,000. The interest rate on the loan is 6.5% with semi-annual payments over a 3-year period. And the loan fully as a fully amortized loan. Payments occur on March 31st, 2026. Or the first payment occurs March 31st, 2026, which is 6 months later. Provide the journal entry for the purchase of the vehicles, the fiscal year end, and the first two payments. All right, so the first thing we're going to do is we're going to solve for the payment. A lot of times, if you take on a loan, you'll be given the payment, but it would be really good for you to understand where that payment came from. And so how do we get there? Again, N is the number of periods, and so it's 3 years, but semi-annual, so it's six semi-annual periods. It's fully amortized, which means that in the future, the loan will go down to zero. We have the present value of the vehicles that we are purchasing, that we are acquiring. So that's coming to us. And then the interest rate on the loan, 6.5% annually, and it's 3.25% semi-annual. Now, this is the full contract right here. So this isn't a matter of trying to figure out market rate or anything like that. This is the terms of the contract. This contract has been offered to you by definition. It's the market rate. And so then we go to solve that. The payment would be $43,741. And again, what this is going to allow us to do, is to pay off this debt over the course of the 6 semi-annual periods. And so again, we use that TVM. Again, we're just taking the TVM from up here. And now we're applying it to a slightly different amortization schedule. So notice that the first three columns are the same. And now the amortization is not amortization of a premium or a discount. It's the loan amortization. And then the loan balance is still out here to the right. And so when we do that, we can see initially we start with 235,000. And by the end of the life of this loan, it will go down to zero. Again, we're fully amortizing the loan. So the way we do it, again, we calculate the payment, $43,741. The interest expense is the yield or interest rate on the loan, 3.25%, multiplied by the prior loan balance. And then the difference between the two is the amortization of the loan. So again, we're directly reducing the loan by the amortization amount. So 235 minus 36,103 is 198,897. That's where that math came from. And then we continue all the way down until eventually we get to a zero balance. There's a little bit of rounding here at the end, but absent a rounding dollar here or there, it should come off pretty much right at zero. If we took it out to a penny, it'd probably be okay. All right, so record the purchase of vehicles using that installment loan. And this is really, really easy. Obviously, we're obtaining vehicles and now we have a note payable. We could call it loan payable, whatever. That doesn't really matter. But the idea here is I do have a loan that I'm responsible to repay. And so the adjusting entry, again, the next payment is March 31st, but we're going to come to December 31st. And on that date, we need to accrue interest. And so when we accrue that interest, again, in this case, it's contractual interest. And so there is an interest payable and an interest expense. The full 6 months would be $7,638. But of course, we're only accruing interest for 3 months for October, November, and December of 2025. Therefore, the amount accrued interest is 3,819. And so we would debit our interest expense and we would credit our interest payable. And then the payment on March 31st, that should be 2026. We record that payment. The big thing there is the cash payment, right? Don't miss a layup. That's given $43,741. We're also taking the other information from the table. Again, we're amortizing that loan. So we're going to reduce the note payable by $36,103. That's why we're debiting that note. And then finally, we are accruing the remaining interest expense of $3,819 and removing the prior interest payable. And again, because we just sort of took that number, divided it by half, the math is going to work out nicely. And so for the next payment on September 30th, 2026, again, that should be 2026. In this case, we don't have to accrue anything. We can take all the information directly from the table. And so when we do that, we take the interest expense, then the amortization of the note itself, and then the interest payment, which is of course a cash payment. So again, we continue that on, every single month after that. All right, so we're getting close to the end here, getting there. All right, so some financial statement disclosure information. So typically speaking, when we report debt, we're going to report it at the net amount. So if a bond payable had a discount, then we would combine them and report one net amount on the balance sheet. That's very, very common. The other thing is if a portion of long-term debt, we already talked about this in chapter 13, but if there's a portion of long-term debt that's going to be retired within the next year, that portion would be called out separately and would be reported as the current portion of the long-term debt. In the notes, companies must disclose the fair value of their debt. The fair value will vary depending on market conditions. As an example, you may issue a bond at par, but over time the bond yield might change. And so if there's a material change to the value of your debt, you're going to report that on your financial statements. Now, again, material is in the eye of the beholder, but you should disclose any information that's material. And if the market value of your debt has significantly changed, which means your credit rating has significantly changed, that would be something to disclose. Another concept we just need to briefly cover here. We covered a lot in intermediate one, but we're going to talk about, basically there's these different ratios that cover financial leverage, and basically there's just different measures of riskiness. And so debt to equity and the times interest earned ratio, those are kind of the two most common ones. And really what they do tell us is it's focused on financial risk. So as debt to equity increases, that means your debt is increasing more than your equity, and that just means your financial risk has also increased. Whereas the times interest earned ratio, as it decreases, based on better able to cover my interest payments, and that would mean my financial risk increases as the ratio decreases. I think I may have said that wrong, but as the ratio decreases, it means I'm less able, which means my financial risk increases. And again, just as a reminder, risk is not good or bad. It just depends. So you can get higher returns if you take on more risk. Looking at the DuPont framework, just sort of a reminder here is that the equity multiplier, which is a measure of financial risk, it does multiply or increase the return you can provide to your shareholders. So it affects ROE, and so basically you have your ROA multiplied by the equity multiplier, and that tells you how leverage can increase returns to your shareholders. But it's really important to note that the return that you're able to generate from any borrowed money has to be more than the cost of that debt. If not, then it's going to work against you. So if I borrow money at 6%, I have to produce at least a 6% return just to break even. And then obviously you want more than that if possible. All right, I'm going to stop there because the next section is a little bit longer, and then we'll pick this up later.